Hey everyone, this is Elijah K. Johnson, and back with us today is our good friend Michael Oliver on Liberty and Finance. Michael, thank you so much for joining us today.
Thank you, Elijah.
Well, it's great to have you. Your website is Oliver MSA, that's for Momentum Structural Analysis. I wanted to have you on today because we are seeing gold and silver shoot higher. Silver is back above that $20 level. And in one of your recent reports, you talked about how a critical momentum level was broken on the upside, but we could actually be seeing precious metals fall from here. Your take on where we are right now in the metals markets?
We think you've made the low. Okay. First off, for gold, it's simply a third time down under 1,700 since March 2021, August 2021, and then again last month, where you found buyers. Now, nobody's talking about that. Everybody's talking about somebody conspiring to sell gold. But how come they're consistent buyers, regardless of the sentiment out there? Keep buying at 1680, 1680, 1680. Now we're pushing 1770. Okay. I think that was the low. That was the third attempt to break through the bottom of a 2-year range, and I think it failed for the bears. Okay. That's a positive. Now, we know that gold miners and silver miners broke through those comparable lows of the last 2 years of floor, which is typical of them because they tend to be screaming babies, pardon me. They're attached to gold, but they're like children, and they scream. They go berserk on the upside more than gold, and they go berserk more than gold on the downside. So you have to keep that in mind when you're investing in gold miners or in silver. But if we've turned, and I think there's pretty good evidence initially here that we've turned sincerely off of a major low in gold, then these two other categories, silver and gold miners, will snap back in terms of the relative performance and outperform gold once again. So they're likely to be better places to be than actually in gold, but continue to watch gold. There are some other major events going on out there, technical and fundamental events. We all know that. The one that's not talked about much that we have focused on at MSA, and I urge your listeners to ask for a sample report on the website. When we send them, we don't bother you again. You get a free sample. But the weekend report we just issued sort of explains some of the issues I'm talking about here. The stock market move from the 2009 low to the 2021 high was the biggest bubble in stock market history of the United States in terms of percentage gain over a protracted period of time. The S&P went up 7-fold. Go back and compare that to the so-called dot-com bubble, where it only had tripled. Or go back to the 2007-9 high before the real estate collapse, where it had only doubled from its prior bear market low. We went up 7-fold in the S&P and 16-fold in the NASDAQ 100. So therefore, I've seen enough major bull market tops in the stock market, and we've called them fairly well in the history of 30 years of MSA, that I can label this one a bubble beyond any bubble we've ever seen. And therefore, the consequences of bubble breakage, especially in an asset category as big as the stock market, is that you'll feel real world effects. The average guy in the street will feel it. Corporations will feel it. Government income will feel it. There'll be all kinds of negative waves that come from this. Few people are talking about that bubble breaking. They're all talking about, well, since COVID, we've done this, or this metric is this, and unemployment looks good, and all this. They're not looking at the bigger picture of a bubble breaking of that size. When it comes undone, there will be wave effects that will hit those metrics that the Fed likes to look at. So we're pretty confident that the Fed becoming data sensitive, as they hinted at their last minutes that they released recently, they'll get data that will verify to them that, we better soften up here. We better back off this rate increase. We better focus the other way. And you can't just look at US markets, you got to look at Europe and Japan as well. And they're in trouble. If that's the case, and if the central banks have to go back to what they normally do, which is to say, print money to support their governments by buying their bonds and to support other assets that they deem to be important, such as high yield corporate debt, municipal bonds, and buying US treasuries because, few other people want to buy them. Then what does that mean? It means they have to reverse policy back toward an inflationary trajectory, which is what's been going on for decades. It's a constant process. If you look at an M2 chart going back to the 1950s, it basically doubles the money supply every decade. The difference now is that over the last several years, it's been far more rapid than doubling. And if these events happen, if the bubble is breaking, as we claim, and it has real world impact on data points, data sensitive Fed again, then the Fed is going to suddenly back off. And as many economists are now mentioning, likely be dropping rates again next year. Well, here's gold, which is probably the most reflective asset on the planet in terms of reflecting the growth in the money supply. In other words, the degradation of money, gold offsets it. No other asset has done that. We've run charts on that recently that show the correlation between gold and M2 is far better than gold and commodity prices or gold in any other asset category. Then what is the Fed going to do if these data points start to flip negative rapidly? We know what they're going to do. I think gold knows what they're going to do. And I think that's why you have certain unnamed entities or major asset managers globally who consistently buy gold under 1,700 and have for the last year and a half. They know that the game that the Fed is trying to play will not play out. They'll have to reverse back to what their role is, to support government debt, hence increase money supply. So I think that's what gold knows, and I think the major asset managers know when they consistently keep buying gold under 1,700. Now, average investors don't seem to get that. They see the gold miners sink a lot more than gold on a percentage basis, and silver as well. But what they need to do is go back and measure the upturns and downturns in gold, and they'll see that when gold goes up, those other asset categories beat gold. And we do spread measurements of that. In our weekend report, we have an example of silver versus gold, which is on the verge of upside breakout. It was on a relative performance basis. When that occurs, we'll have even more conviction that, in fact, the monetary metals have bottomed. And the good reason is what I've explained.
It is interesting what we have seen recently, though, since we have heard the Fed Powell speak last, the Fed meeting, and there was the 0.75 point rate hike this last Wednesday. It seems like we've seen a rally in all the markets. Why do you think that is? And it sounds like, at least for the stock market, you don't think that is going to be sustained. You're looking for a further looking for further downside from here.
We think the damage done in January for the NASDAQ 100 and February close for the S&P 500 was conclusive. They've topped. Okay. That doesn't mean they just go down, 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 down. No bear market in the U.S. stock market history has done that. It's always had counter trend rallies. 3 weeks ago, we called for a counter trend rally in the S&P. At that point, the S&P was like 3850. It's now up to 40. It reached, I think, around 4150 3 weeks later. At this point, we don't trust the rally to sustain. We think it is just a teasing counter trend rally. And in part, I think it's because the same reason that gold has rallied, though I think they'll divorce. And that's an anticipation that the Fed policy won't continue. A lot of economists have hinted at that, and I think they're right at this point. They didn't realize it before, but now they do because the data is starting to hint that the data is starting to weaken. So the stock market thinks, oh boy, the Fed's going to get loose again. I think it's too late for them. The reason is that the stock market is turning down from a bubble high. Again, 7-fold in the S&P over a dozen years, 16-fold in the NASDAQ. When that comes undone, such fundamentals as Fed policy changing from hard to soft, won't matter. They're going to come undone because it's a bubble. You can't stop it. The Fed has never been able to stop a bubble break before, .com nor the 2007. They tried, it didn't work. They went down. This time it's going to be worse. I think the real beneficiary will be the monetary metals, and they will be a standout beneficiary. And I think coincident with that, recently we've seen some strength in the dollar, which a lot of people are pounding the table about. They shouldn't, because if they go back 50 years in the dollar index and look at the price charts, even the price charts say, what a rally? That's not a big deal. It popped up out of a 6-year wide range that was dead as heck for 6 years at a very low level, popped slightly out of it. Now we're back down in it. It's indication that the dollar rally was short term. And if it fails, that will be more wind at the back of gold. And frankly, we think the dollar index is within about literally a point. Right now it's trading low 105s of fully breaking down. And if that does, then that's another wind at the back of gold, and another yet assumption by many investors that it's going to go up. That's false. So I think both the stock market and the dollar index will likely take the same course, regardless of whether the Fed actually does in the coming months soften its policy. I don't think that'll help. It's too late. The bubble is already broken.
I know we had you on a couple months ago. I think this was maybe like 5 months ago or somewhere around that time. And you had said that if the Fed reverses, what will happen this time is it won't be the stock market that reacts to it, the monetary inflation that the Fed will be creating, that will all go into precious metals. So can you expand on that? It seems like that's what you're saying is even if the Fed reverses at this time, the stock market will not react positively to that. The dollar will not react positively to that. No. We're going to see the money instead flow this time into precious metals.
It's always an issue over the years. And again, I've been around 48 years in the market since gold was legalized. I started working for E.F. Hutton, chairman of the COMEX I worked for. He was also head of Hutton's commodity division. So I'm intimate with the monetary metals. But Fed policy does not reverse trends that they create the bubbles, and when the bubbles break, they usually cannot, in fact, they cannot stop them. I don't know of an instance where we've had a bubble break, the .com or the real estate bubble in 2007 to 8, that they've come in and tried to defend and managed to stop it from happening. This happens to be the biggest bubble ever, meaning, what does it mean when you have a bubble? What it means is over a protracted period of time, the price action of a given market, especially it's as big as the stock market, influences people's decision-making about commitment of capital, assumptions about the future. And I'm not just talking individuals, but corporations, even governments. And when those assumptions are proven to be wrong, that means that errors that were built based upon those assumptions over years were wrong. And if you've made years worth of false assumptions, committed capital to it, committed all kinds of things to it, when it comes unwound, it's huge because the errors are compounded. They're not just over a 2-year period. They're a 12-year period we've had this bubble. So the error is too big. It can't be unwound. The main beneficiary we see again is the one that tends to replicate, in fact, it replicates the degradation of money. And that's what central banks do. Whenever they go the soft route, it means monetary growth occurs. Interest rates are driven to lower levels than a market would otherwise price them. And you have further errors created. And ultimately, it's the investors who take that river flow that the central banks create when they're panicked and direct it where they want, where the investors want it to go, not necessarily where the Fed wants it to go. So at the 2009 bear market low in stocks, for example, MSA went major bullish. In fact, the week prior to the low, we said the low would occur at a certain price, and it occurred there, and we were major bullish. That was because we thought it was the market had paid its dues, and the river flow of investment capital would go back into the market. This time, a new river flow will not go into the market. I think what the river flow is going into is what we see when gold gets under 1,700, under 1,700, under 1,700, 3 times since March of last year. Those are large asset managers putting the river flow that they anticipate, and that has already occurred, in fact, into what? An alternative asset other than the stock market. They don't trust asset values. They go into gold. And I think that will persist over the next couple of years in a fairly dramatic way, more than I've ever seen in my entire career, in fact.
And it is so interesting because right now, so few people are actually invested in precious metals. I think it's like 0.5, so 0.5%, 0.5% of assets are precious metal related. The precious metal sector, even the mining stocks and all that. So it seems like, as Rick Rule often talks about, even if you just go back to what has been historically, that is a huge increase, multiples of where it is today.
Mm-hmm. And you've got to realize that too, that it's a smaller market than the equity markets, particularly silver and the gold miners and silver miners. They're a teeny little sector compared to any other stock market sector. So if any flow shifts because of doubt about the stock market, let's say, and desire to be in something that, one, has been washed out, not gold, but the gold miners been washed out. They're not going to zero, folks, okay? And gold starts to turn up. That's where the investor class is going to put the money. And as you said, because it's such a small arena, that it doesn't take but a 0.5% or 1% increase in that investor interest, and that little sector could go berserk. And I think that's likely what's going to happen.
Definitely. Now, for our viewers just joining right now, we're with Michael Oliver of Momentum Structural Analysis, olivermsa.com. We're live here on this August 1st. Michael, I did want to ask you, besides the precious metal markets, I also do want to ask you about the energy sector. We've seen this has been one of the sectors that has obviously been impacting everything. Energy impacts the price of everything, and that's one of the factors of why we're seeing so much inflation right now. Your perspective on where the energy sector is right now, and especially when we look at oil.
We called a bull move in oil at just about $40. We added in the mid 70s in terms of our bull signal. At this point, it went up to 130, the WTI crude. It's now hovering in a violent range between the mid 90s and, let's say, 110. This is kind of what we expected. One, it's not a good place, in our opinion, in terms of if you want to buy commodities. It's not probably the optimal place to be initiating a new position, period. Our buy signals were at lower risk, higher reward levels. This point, we're now dealing with speculative fever. We think, though, that likely prices will stay high. And it frankly doesn't matter to the global economy in terms of turning it down, European economy in particular. All you need is to just stagnate oil prices up here for another year and keep natural gas prices where they are now, and it chokes off the world economy. They don't even have to go higher. So the central banks are going to have a real problem, not just in stopping the quote commodity inflation, which they're not going to do, by the way, but even if it stalls, it has a choke effect. And that's what we suspect is going on, is that oil, and particularly natural gas, which has much further potential, we think. But still, that sector in general, in relation to, let's say, the food sector, is probably not an optimal place to be entering new long positions. Likely it's going to stay up here, but it's not a place to be going long freshly. There are other places in the commodity arena, and I think gold and silver are one. And they don't tend to move. By the way, gold does not tend to move with commodities. Most people think, well, how come gold went down while the commodities went up? Well, look back at the charts. Gold made a low in 2015, late in 2015, just above 1,000, and doubled. Commodities were in the sewer that entire time. And it wasn't until after the August high in 2020, when gold reached $2,070, that the commodity index turned up. So there was no correlation between gold going up and commodities going up. Now, when the commodities went up, gold went into this range. And so people think, well, gee, gold is terrible. It's not reflecting inflation. Inflation is not commodity inflation. It's monetary inflation. a lot of asset categories get inflated by central banks. In fact, over the last dozen years, it was the stock market. That's where the inflation was, not in commodities. We think that probably the Bloomberg Commodity Index, by the way, which is the broad basket of not just the energy sector, but grains and meats and so forth, is likely to have another major wave up. It's trading right now, the Bloomberg, at around 120. That's about double plus off of its bear market low in late 2019, when we called for a commodity explosion. It's been congesting violently. Had a high at about 140, dropped under 120, got down to, I think, 112 or something like that. Right now it's 120. If it goes back up to 132 on a monthly close, what are we talking? 12 points? It's a 10% rally in the Bloomberg, okay? You get a 10% rally back up, and we think Bloomberg is going to launch a whole new wave. And we suspect that the components that will drive that wave will probably be more in the food category than in the energy category. The food category looks like it has more potential, like soybeans and so forth. So that's where I'd be looking. But I still think, and this has historically been the case in, like, for instance, in the late 70s bull market in commodities and gold, which gold led, by the way. Gold outpaced the commodity indexes. So we still think that gold is likely, if you're going to have further inflation in commodities, that is, which we think you'll have, the gold will be a better place to be than in even soybeans or corn or whatever that we think could be quite strong over the next year or so. So anyway, that's the commodity situation. And I think that energy is probably not the best place to be jumping in right now. If you're long already, fine, protect your positions. But this is not a place for new entry.
Now we have a viewer's question, Michael, for you here. This one is from Sarge. They want to know your thoughts on the BRICS nations trying to develop a new reserve currency. And this kind of gets into the theme of that it seems like there are a lot of nations moving away from the dollar as a world reserve currency. It doesn't seem like this will happen overnight, that the dollar will lose its world reserve currency status. But your perspective on that whole situation?
I think that the monopoly position of any given currency, like it used to be the British pound and so forth, is about to change. And if the dollar, and again, in our weekend report, we give specific numbers on it. If the dollar index breaks below certain levels, we think that party is over. When that happens, I think the notion of reserve currency could go out the door, where it's no longer a currency as a reserve. Nobody has a monopoly over good money. We think that likely there will be currencies created in, who knows, it could be even China, who knows, where you have gold-backed currencies or something backed by something, probably gold. And the onset of that trend will change the world currency markets. Plus, we now live in a electronic world that's connected by the microsecond. So it's not like the old days where the British pound did this and you learn about it 2 weeks later. We live in a world where these sort of changes can happen quickly, and where people can adapt to them. And for instance, in cryptos, for example, it's been a good example. Like, everybody can watch various cryptos do various things, and it's created a notion. The sheer emergence of the cryptos has created the notion that, we don't need a monopoly government currency. A cryptocurrency, that's fine. Yes, that Bitcoin's been beat up lately, and we have a report on it. And we think probably the next downside in Bitcoin, which we think will occur, might be its final down leg. But that emergence of that market has created a mentality, especially among young investors, that, what do we need a monopoly currency for? These can pay for things. We can change. Instantly. I can instantly judge the value of my money. And if I don't like it, I can switch. And so I think the world is about to fragment, just like it is politically. We're decentralizing globally, politically, opposite to the universalization, which everybody applauded a decade ago. Now it's going the other way. I think that will happen in the currencies as well, in which case you won't have a reserve currency anymore. the world will deal with multiple currencies, probably some of them being gold-backed.
It does seem like that with the emergence of cryptocurrencies, that there has been an awakening of what inflation is, what currency itself should be. It should be something of real value. I think that cryptocurrency, whether you like it or not, has kind of opened people's eyes to this idea of like, well, you know, a lot of people are more interested in gold now and everything like that. So it seems like there really has been an awakening because of these alternative currencies that have come about.
I think it's like a revolutionary act almost implicitly, you know. No doubt the young generation, their parents would tell them, oh no, you're gonna have the dollar, you know, that's it, you know, et cetera, et cetera. The grandfather would tell them that. But they've learned something new. And yes, they've gone down in value recently. But the one virtue of at least Bitcoin is that it can't be infinitely created, expanded. There's a limit to the supply of Bitcoin. You know, it gets less and less. And so the growth of the quantity of Bitcoin gets less and less. So at least it has that virtue above and beyond any of the government fiat currencies, which at a moment's notice, they can push a button and inflate it to support their government's bonds, et cetera. Bitcoin won't do that. So we suspect at some point, probably soon, and we do suspect there might be another down leg in Bitcoin. We don't trust the current rally. But that down leg might be the last one. And again, we analyze that every 2 weeks. But again, we've done studies of Bitcoin versus gold. And about 6-7 months ago, when Bitcoin was up in the 50,000s, we declared that, okay, it's over. The relative performance of Bitcoin versus gold, which had been positive since 2017 or 2018 anyway, Bitcoin had beat gold on a relative basis. That changed, in part because gold held steady and Bitcoin went down, but the spread relationship or the relative performance relationship shifted long-term, favoring gold. And we think that that will still be the case. But nevertheless, we think that Bitcoin emergence has in effect been a revolutionary act that will teach a lot of young people, especially, about to question the nature of fiat currencies.
All right. Well, Michael, we really appreciate your time today, and especially this late night live stream. Any last thoughts before we let you go, and where can our viewers find you online?
Well, it's olivermsa.com. And again, request some sample reports, but our latest weekend report sort of summarizes a lot what I said, including with some charts that are quite informative. So feel free to request samples. And thank you for listening.
All right. Thank you so much, Michael. Thank you so much for your insights, and God bless.
Thank you, Elijah.